The daily upside. Let's see what they got to tell us. So, good morning. Legacy automaker like GM and Ford have a potential secret weapon in their quest for electric vehicle market share. Baby boomers. A survey of U.S. adults born between 1946 and 1964 by Morning Consult revealed that 38% would prefer to buy an EV from a traditional car company with a gas-powered history, and only 12% said they prefer to buy from an EV-only company. Someone should tell where they're original to get into the health food business. Morning brief. Boeing 737 MAX is back on track, but another plane has hit the skids. Ski resorts are struggling to keep the slopes open, and the reason isn't COVID. What's the reason now? Walmart makes a big push into Fintech. So, what's going on with Boeing? Let's see. Boeing lost $4 billion last quarter, but its scandal-ridden 737 MAX has finally turned the corner. When one door closes, another one opens. That's the famous optimist mantra. But in Boeing's case, it's the door itself that needs fixing. The world's second largest aerospace company announced Wednesday that it has overcome past issues that dogged its high-profile 737 MAX aircraft and generated positive cash flow for the first time in 3 years. On the other hand, the financial fallout from production flaws and fuselage doors on one of the best-selling planes, the 787 Dreamliner, has gotten substantially worse. Whoa. The comeback skid. Boeing is coming off what CEO Dave Kahoot called a rebuilding year. Aircraft sales bounced back after the 737 MAX airliner was grounded following multiple crashes and the pandemic wiped air travel off the map. In 2021, Boeing delivered 340 planes, or almost double its 2020 goal. A great improvement, although somewhat overshadowed by the fact that it got its clock cleaned by chief rival Airbus, which delivered 611 planes and bested Boeing for the third year in a row. The company's comeback narrative has some solid threads, but leaves a lot to be desired. Boeing's cash flow, an all-important metric for a mature company like Boeing, totaled $494 million in the fourth quarter, a huge improvement from a $4.3 billion outflow in the same quarter last year. Boeing still managed to post a net loss of $4.16 billion in the fourth quarter, though the airline giant took a $3.5 billion charge associated with delays to its 787 Dreamliner, which it hasn't been able to deliver to airline customers on time because of structural production problems. Out of the woods into the clouds, if Boeing were to adopt another optimist mantra, seeing things glass half full, it would be wise to look past current production challenges and instead look back at the trajectory it previously beleaguered aircraft. After coming to a complete halt, the production volume of the 737 MAX has increased to 26 a month, and Boeing expects to deliver 500 this year. Wow, I guess that's why their stock fell. I saw their stock go from like 220 to 190, I think, or something like that. So sad. Ski resorts are struggling to find enough staff to keep it open. But don't worry, you guys, because Jerome crashed the stock market and everyone's gonna go back to work, you guys. Ultimately, this was the ultimate intention of the Fed. So the annual call to hit the slopes usually means speed and exercise amid the thrilling beauty of nature. This year, it's more like heading to the DNV. New data shows ski resorts have been slowed, even halted by major staffing shortages. And for holidaymakers and leisure enthusiasts alike, that's meant more standing in line than time on the Alpine. The culprit might surprise you. Get in line. Staffing shortages aren't new to the ski industry. The National Ski Areas Association said 60% of resorts weren't fully staffed in winters of 2020 to 2021, and this year's resorts have again been operating with skeleton crews. Vermont's Killing Resort, for example, said staffing levels are down as much as 30%, and it's been forced to curtail operation. Colorado's Vails Resort, which runs 37 ski areas, was hit with a petition signed by 44,000 customers complaining of the lines longer than a Tolstoy novel, and its Stephen Pass Resort in Washington State. Wow. The fast-spreading Omicron variant of the coronavirus seems an obvious culprit, veiled toward the New York Times, that the variant has put as many as 10% of the employees out of commission at once, but it's not actually the main driver of staff shortages, according to the industry insiders. Real estate is. Ski resort workers have struggled to afford the increasingly pricey and scarce housing stock in dream mountain environments dominated by wealthy owners, even as many resorts have lifted the minimum wage to $15 an hour. In 2021, home buyers spent the most ever on property in Colorado resort towns when 11.2 billion changed hands in the state's 8 western slope countries. Everything dried up, Aspen skiing company executive Jim Lang told The Times, adding buyers have converted long-term rentals into short-term rentals to make more money, shutting out resort staff. Overnight, we went from challenge to crisis mode. Wow, I wonder if this is like Airbnb's fault right here. It's interesting the way everything's happening. This is so interesting, right? Taking a pass. Some have struggled. Some have suggested Vail's resorts are struggling because the company sold 700,000 more Epic passes, which gives access to multiple resorts than it did last year by making it a 20% discount, but pass holders haven't been making use of the bargain. Skier visits are actually down 1.7% this season compared to 2020 to 2021 and down 18.3% from 2019 to 2020. Interesting. So, what is this? Another stock advisor admin. So, with Fintech acquisitions, Walmart aims to manage employees' banking needs. Okay. What's the quickest way to build a fintech? How about starting with more than 1 million built-in customers? Few companies can make that kind of move, but for Walmart, it's a cinch. The retail giant announced Wednesday that it's acquiring 2 fintech startups to combine with its in-house banking venture with the goal of building an all-in-one finance app. Walmart employees naturally will serve as the ground floor users. Wow. Everybody wants to be in the fintech business, and like Walmart getting into it too. This is crazy, right? 3 becoming 1. Walmart's fintech creation was until now known as Hazel, but will soon be called One. The new moniker comes from One Finance, one of the 2 companies it's buying. One is an app-based neobank, basically an app that lets users manage money, apply for a debit card, and access financial services with lower fees than traditional banks. The company being absorbed is Even Responsible Finance, which employers can use to offer early paychecks. The other company being absorbed is Even Responsible Finance, which employers can use to offer early paychecks. The business plan allow more of Walmart's 1.6 million employees to get paid early with a new One app and ideally convert them to users of other services. The groundwork has already been laid. Walmart is a major customer of Even, which lets workers access up to 50% of their pay in advance for a fee, meaning many of its workers are already on board. One's digital bank accounts will be able to provide employees and potentially Walmart's 100 million weekly shoppers a seamlessly place to deposit and manage their earnings and savings. With all those customers lined up on top of the 120 million monthly users of Walmart's shopping app, the retailer could potentially create its own super bank, its own super app. A walled environment where customers can get paid, do their banking, and go shopping all under its exclusive banner. The cost of acquisitions, which are expected to close in the first half of the year, was not disclosed. Even and One combined were valued at $400 million during the last fundraising rounds, according to the Wall Street Journal, and they could soon absorb more fintechs. Another $250 million is earmarked for acquisitions. Wow. This is crazy for Walmart. Especially, I know right now a lot of people are investing in SoFi. I know I held a position until I sold out of it. It just keeps going down. It keeps going down. I don't know what to invest in, but there's so many fintech companies that are trying to get everyone's banking needs. It's going to be tough out there. So if you're a SoFi investor, like, you need to consider stuff like this, right? Extra upside. Use an Instagram account for work. Be careful. A siphoning scam has been trying to hijack company accounts. I wonder why. The Federal Reserve plans to raise rates as early as March in a bid to cool inflation. This is so interesting. So it's interesting. This newsletter did not cover anything about the rising interest rates until the end, which is cool. This is why I like subscribing to different newsletters, because everybody talks about different things, right? Like over here, we learned about the ski resorts that they don't have enough staff. We learned about the Boeings that, about their planes. So this is one of the reasons why I like reading all these different newsletters. And this is something I like doing. I like to read newsletters. And usually I read them by myself. But I figure why not come on YouTube and read them. So if you enjoy this and if you want to keep seeing me read, I'm not the best reader out there. I'm not going to sit here and claim I'm a pro. But it makes me feel less lonely to read this stuff with somebody, right? So make sure to hit the like button, subscribe if you're interested. And this was The Mysterious Investor.